Hi, and welcome to this Premier Training revision video, which will look at two key concepts in marginal costing: contribution and break-even analysis. The contribution made by the sale of one unit of product is the difference between the selling price and the marginal or variable cost of that unit. Variable costs are typically made up of materials and labour and occasionally variable overheads. It does not include any fixed overhead costs. The contribution made by every unit goes towards meeting the fixed costs of the organisation, and once these have been fully covered, any contribution after that is profit. Imagine a tin of baked beans. There will be variable costs of materials such as the beans themselves, sauce, the tin, label, etc. These are costs which are incurred by every tin of beans made. Similarly, there will be labour costs. This is direct labour. This is the labour associated with directly making each tin of beans. The selling price for the tin must at least cover these variable costs. Any excess is the contribution. So we can see that the contribution per unit is the selling price minus any variable costs. However, we can also think of it in terms of total contribution, which is the organisation's total sales income minus the total variable costs. This will also be the same as the contribution per unit multiplied by the total number of units. We can see how this works if we look at a profit statement. The total sales income minus the total variable costs gives the total contribution. The fixed costs of the business are only then deducted at this point under marginal costing. The important thing is that they are treated as a cost for the period rather than as a cost of the product. The concept of contribution is hugely important in marginal costing. One way it can be used is to determine the break-even point, that is, the point at which no profit or loss is made. This will be the level of output at which the company makes just enough total contribution to cover its fixed costs, so that its profit is nil. We can see on this graph that the company's break-even point can be shown at the point where the sales revenue line, shown in red, crosses the total cost line, shown in purple. At any level of sales below this, the company makes a loss, and at any level of sales above this, a profit is made. But the break-even point is where there is no profit or loss made. We can use the contribution to help identify the break-even point. We need to know the selling price and the variable costs per unit, from which we can calculate the contribution per unit, and the fixed costs. In this example, we know the selling price of a toy is £20, whilst the variable costs are £10 per unit. We also know the fixed costs of the business are £5,000 per month. Each toy sold makes a contribution of £10 from the selling price of £20 minus the variable costs of £10 per unit. And we need to sell enough toys, making £10 each time, to cover the fixed costs of £5,000. We can calculate this by dividing the fixed costs by the contribution per unit. £5,000 divided by £10 equals 500 units. If we sell 500 units at £20 each, we will make £10,000 sales income. But we know the variable cost will be 500 times £10, which is £5,000. This leaves a total contribution of £5,000, which is just enough to cover the fixed costs of £5,000. If we construct a table, we can see how at levels of sales below 500 units we make a loss. At 100 units the loss is £4,000, and at 200 units the loss is £3,000. At 500 units, however, there is no loss or profit, and at levels above this we start to make a profit, and the profit increases by £10 for every extra unit we sell. Here, in the graph from earlier, the break-even point is shown at 500 units. Break-even analysis is really useful, especially when looking at setting up new businesses or selling new products. However, it's a little simplistic for more complex analysis, as it ignores factors such as discounts, different selling prices and stepped costs. Hopefully, you now have a clearer understanding of how contribution is such an important concept and how it can be used to calculate break-even points. Thanks for watching.